Good morning. I wanted to spend a little bit of time talking to you this morning about retirement and living in retirement. Planning for it, knowing where you are is an important part of that. Are you in retirement now? Are you considering retirement? I've been retired since 2006. I retired when I was 55 years old. So I don't work. I don't have a job because I'm retired, and that's why you see in my surroundings I'm just dressed casually. I'm not selling mutual funds or annuities or anything like that. I'm just managing my personal finances so that I can enjoy my life here in this COVID world and limit my exposure to going outdoors as much as I need to, but live my life as I choose to live since 2006 when I turned 55. And I worked in the chemical industry for many years and built up a 401k. Been contributing before I retired to a personal IRA since I was about 31 years old, I think, is when I started it. I also had a universal life insurance policy that I started when I was in my 30s. And so what I wanted to share with you is what I think you might consider in planning your retirement. I'll try to keep this short, but hopefully help you make some good decisions. The first thing you need to do is determine your monthly spending. In other words, a budget, that kind of thing. But you've got to understand how much money is going out to determine how much income you need in retirement. And so, what I recommend you do is religiously go out and collect receipts for when you go out to dinner or to a show or you order something on the internet. Keep good track of that. Of course, you get statements, credit card statements. That'll help you keep track of what you're spending too, or bank statements, whatever. But it's the little things that can kind of slip away from you. So if you go out and go to a McDonald's or Burger King or your favorite restaurant, make sure you get a receipt for that. If you leave a tip, write that down at the bottom. And just make it a habit of always asking the grocery store clerk to say, get that receipt, and don't put it in the bag, put it in your wallet, and save everything. When you get home at the end of the day, have a file or a box where you put those receipts, and then at the end of the month, you go through those and find out exactly how much is going out the door in terms of spending. And if you're like the average person, it's going to be somewhere between $3,000 and $6,000 a month. So because you've got to know how much you're spending in taxes, for example, and prorate this. If you are familiar with Excel, create a spreadsheet of exactly how much you're spending every month. Include in there your dental visits, your property tax, the taxes on your car, your insurance on your car, cars if you have more than one. So anyway, you see where I'm going with this. Just make sure you total all that up, and so you know how much you're spending, because you got to know how much you're spending every month to determine how much income you need in retirement. All right, and then if you're considering starting Social Security, whether you started at the earliest date you can at 62 or at your full retirement age in terms of Social Security, which is 65, I think that's correct now. I started when I was 62. And if you are like me, I'm in my 70s. I just turned 70. So decide where you are in your retirement. Are you still in the accumulation phase, where you're building wealth and working and contributing to 401k, or have you made the transition to distribution? And that's where I am. And if you are on Social Security, I would suggest that you are in the distribution phase, because you are beginning to take money out of your Social Security rather than adding to that. And so based on that, if you're retired or considering retiring and starting to take Social Security, then you are in the distribution phase of your wealth rather than accumulating wealth. I mean, it's not 100%, because you still may accumulate wealth to some of your investments or whatever, but if you're like me, you're somewhere between 60 and 80 years old, decide where you are. I'm in the distribution phase, and decide that for yourself. Are you mostly in the distribution phase or accumulation phase? Now, you know how much you're spending every month. We discussed that. You've tracked it for a while. You know how much. You can adjust it as the months go by, but have a rough idea of how much it is. And then you've got to total up your income to figure out if you have enough money to cover those monthly expenses from your sources of income, which are going to be Social Security is foundational, pensions, any pension money you have is foundational, and income from your IRA or life savings or other instruments. And if you add up that monthly income versus your spending, and you realize you don't have enough to cover that monthly spending, then you've got to figure out where that income is going to come from. And there are ways to do that. For me, one of the things I've done is I have my fixed income, which is Social Security and pensions, and my wife's Social Security. And then I also have income that is coming out of my IRA. I have my IRA generating income every month, okay? And then I kick that, I have most of my funds in Fidelity. That income then comes out into my Fidelity cash account where I pay my bills, okay? So I've got Social Security going into Fidelity automatically every month, and I've got the dividend and interest income, for example, off my IRA going into that, and that's how I manage my finances. The other thing I also have is a fixed index annuity, which I draw a small amount of. I could draw more if I need to, but if you do that, then you just have to pay taxes on it. So that's why you need to find out how much you're spending so you can set your income to come in and not draw too much. Otherwise, you're going to have to pay taxes on that, assuming it's qualified income. And qualified means taxable in financial speak. So set your accounts up so that you have that income coming into your cash account where you pay your bills, and structure it so you have enough income to cover your monthly expenses. And the other thing I want to emphasize today is you really, if you're in the income distribution phase, your days of rock and roll, let's invest in the market and buy Bitcoin, or heavily into risky stocks that they could pay off well, but you could also lose on them. Those days really are behind you, and that's the purpose of my video today, is for you to think about, decide where you are. And let me emphasize to you, if you're the average person who's worked all your life, and you've got some Social Security income that you can begin to draw on, and you have some IRA savings and some 401ks that you can now cash out on, your job as a retiree is to not lose any of that, because that is your source of income. So if you start drawing income off of it and you've placed it at risk, for example, in the stock market or the bond market, mutual funds, we have all learned, and if you're in retirement or considering retirement, you've been on this planet long enough to know that you can see all of that go down significantly. If there's another real estate crisis or another interest rate crisis, Russia invades Ukraine, a terrorist attack, lots of things can take investments and drive them down. And if you're trying to draw income off of those incomes, those accounts that now have been driven down by some force you have nothing to do with, like a terrorist attack or the Russians invading Ukraine, that drives the stock market down, then you're affected by that. So your job is to 100% avoid that. So you need to put your financial house in order so that you have steady income off of things like Social Security, IRAs, annuities, and determine your own mix. But your nest egg is made up of something that is going to throw income off to you, but not decline in value. That is the key. And you need to structure it that way. So in this little house you're constructing of safety, that is your lifetime nest egg, that is for your wife and children and grandchildren, your job is to protect that and not let it decline. Then you have to structure that. So you've got Social Security at the foundation. You can have an annuity that provides regular income. There are different types of annuities. We can talk about that another time. And your cash accounts, which if interest rates go up, those will provide you a little income. So that's what I wanted to share with you today. And also make sure that you are maximizing Social Security. If you are a fellow who's worked all your life and you have significant Social Security income, let's say it's $2,000 a month, let's throw that out. Let's say that's your income from Social Security. And your wife also worked. But she took some time off to have the kids and maybe stay at home for a few years while you were working. So her income from Social Security is not going to necessarily be as much as yours because she didn't contribute as much over her lifetime. What I want to share with you today is if she goes in and applies for Social Security and you apply for Social Security, yours is based on her income, hers is based on her income, that's then going to go into your household income. But realize that you can apply with the Social Security Department to have her apply for spousal benefits and substantially raise her Social Security income based on your income. It helps it be a little more equal, not the same amount, but you don't have to draw based on what she contributed. Okay, so make sure you look into that, because the Social Security Department is not going to pick up the phone and say, "Hey, Mr. and Mrs. Smith, you're not getting your full monthly benefits. You need to apply for a spousal benefit." If your wife applies separately from you and you apply separately, you're not going to get as much coming in every month if her contribution was less than yours over a lifetime. So take a look at that. Talk to your wife. Find out who had the most income and if it can substantially be increased by filing with the Social Security for spousal benefits. In my case, In our case, it increased our Social Security incomes significantly. I'll put it this way: it makes a car payment, okay, and that's significant. So make sure you look into that. If you like this video, give me a thumbs up, and I'll leave some more videos on how to survive retirement and how to structure